We're putting the spotlight on the auto sector right now. There's been a lot of weakness, obviously, in both PV sales, also two-wheeler sales, at least with month gone by, were nothing much to write home about. The vehicle registrations, March data shows a 15% decline in total registrations as well. So is this pain going to continue a while longer? What can FY26 bring? Kumar, Rakesh, India Auto and IT analyst at BNP Paribas is joining in for some thoughts. Of course, we're talking only autos today with Kumar. Great to have you on the show, Kumar. So what's the sense so far? I mean, it's, and we've discussed this with you earlier as well. In PVs, you told us that maybe financing is a bit of an issue, though companies like OEMs like Bajaj Auto kind of denied that. We didn't ask them about it. But what's the sense? Passenger vehicles as well as two-wheelers, will March continue to be as sluggish and weak as what we saw in February?
Hi, good morning, Surabhi. Thank you for having me on the show. Yeah, we have been on your show earlier as well. Since late last year, we have been talking about that financing, especially in the two-wheeler space, seems to be quite stretched. Delinquencies have started going up. That is pushing the credit cost of financing companies higher. And that will limit their ability to lend aggressively that we had seen over the last 2 years. The effect of that has been visible over the last 3-4 months. And we think it will continue for a while. If you look at the financing company's performance in the December quarter, if anything, the credit cost either remained elevated or further increased. You look at the microfinancing institution, even though they are not directly financing, they do help in creating a healthy cash flow in the low-income households. There, the PAR 180 days, PAR 91 days have continued to shoot up in the December quarter. And interestingly, if you look at the states where microfinancing institutions have the highest exposure to, are the states that have seen the highest slowdown as well, as the disbursement by these microfinancing institutions dramatically slowed down in December quarter. Since December, we have been doing a lot of channel checks, and what we are gathering is that things have not improved as yet. If anything, potentially have deteriorated further. And that creates a headwind for the demand, because if the easy financing, which was one of the major tailwind for the demand, is no longer available, we'll continue to see the market to readjust at a lower volume, which is what we are seeing. Compared to that passenger vehicle, we would expect that to start stabilizing at some level. There were two major headwinds the industry was facing. One was the affordability had dramatically slowed down, but in fiscal 23-24, we didn't see much of the impact of that weaker affordability because there was still a strong pent-up demand which the industry was catering to. Now, as we entered into FY25, we simply were witnessing the perfect storm as the base was really high from high pent-up demand years, and the affordability had dramatically weakened during the last 2 years. The good thing is that both of these two headwinds we think has largely receded. We don't have a high base, which entering into FY25 was an issue, and affordability that we have been tracking on a monthly basis seems to have started stabilizing over the last 1 year.
Kumar, sorry, just allow me to come in over here to understand this financing issue in more detail. Because what's happening is that actually tractor volumes have really picked up very well. So the financing issue does not seem to be impacting at least rural demand. Because if rural households can invest in tractors, I mean, would financing be a concern for two-wheelers? So the two-wheeler financing issue that you're talking about, where is that showing up? Is it largely urban centers or tier 2 towns? I'm not able to sort of understand the two because tractor sales are really improving. But two-wheelers, you're saying, are constrained by financing, including, MFI stress. So could you just elaborate on that point?
Yeah, that's a very fair observation, Surabhi, but that essentially just highlights that how the demography and the customer base of two-wheeler customers and tractor customers are not very alike, that sometimes we may confuse as they have very similar customer segments. There are some very nuanced differences between those two. Two-wheeler caters to a very large segment of the rural market. They are not catering just to the farm-exposed customers. Whereas tractor obviously is exposed only to a particular segment in the rural economy. And if you look at the rural economy's farm segment and the income growth that the rural segment is going to see from the Rabi crop, it's going to see about 12-13% of income growth. So actually the customers of tractor are sitting on a pretty healthy income growth going in the latest harvesting season. And that is partly also helping the strong growth that we are seeing. Partly also the low base of last year is also helping in the strong numbers that we are seeing. Now, one could expand that and to say the similar benefit should reflect for the two-wheeler customer base as well. But the challenge is, as I was saying earlier, that the two-wheeler customer base is far wider compared to how tractors are. And if you look at the rural economy outside of the agricultural activity, it hasn't been as strong as the rural activity is. And on top of that, the aggressive lending, we saw almost 20-30 percentage point increase in financing penetration in a short period of time. That just tells us that the industry had gone in a very high intensity in terms of expanding the footprint in the rural and as well as in some of the urban markets. And that will need to be readjusted.
Right. What would your top picks be in this current environment?
So as you would have noticed, obviously, we would prefer passenger vehicle companies compared to two-wheeler companies. Within passenger vehicle companies, we like Maruti Suzuki from a long-term perspective, from a 2 to 3 year horizon. We think a lot of catalysts are going to start playing out for the company in the second half of next financial year. We think once they start launching their hybrid variant of existing models, that would be a game changer for the company and possibly for India as well. We'll see an acceleration of hybrid penetration in the country, something which we have seen globally in most of the markets, that hybrid powertrain tends to do much better than most of the other powertrains. We are yet to see in India, and we think that will start happening by next year. Mahindra and Mahindra is our other top pick, which we like because of a very solid growth, both on volume and earnings that they are delivering. And we think it will continue to deliver in next financial year as well. Looking at the model launches, we think there is a clear path for a double-digit volume growth. And as we were earlier talking about, the tractor segment also seems to be doing pretty well. And as we go into next year, we think some of their loss-making international tractor subsidiaries, if they exit those, there could be margin expansion as well. Finally, from a cyclical pick, we have Ashok Leyland because we think that given the price where it is, we have started seeing some green shoots, at least on the transportation activity side, looking at how the diesel demand has now started turning very strongly. The e-way bill generation has started turning very strongly. These are some of the initial signs which tells us that the demand for haulage activity has started picking up, and that should translate into better volume growth next year. And given the price is, we think the risk reward looks very favorable.
Okay, thank you very much for joining us. So that's the auto space in focus.